Safe Money Talk with Rick Liuag. Rick is a safe money specialist, primarily serving Southern California, but he's sought after nationally for his expertise in helping people secure their retirements. Mr. Liuag is a licensed insurance professional in the state of California and specializes in working with business owners, people who are near retirement, or those who have already retired with wealth management, income planning, and asset protection strategies. And now, here to talk to you about safe money and retirement, your host, Rick Liuag.
Hello again, and welcome to Safe Money Talk. I'm your host, Rick Liuag. This is where you get the straight talk that you won't hear from your CPA, your financial planner, your tax attorney, your group health insurance agent, or your broker about what the actual threats are to your retirement savings and to your business. Last week we had kind of a heated show. I got a lot of calls and emails on that. Folks talking about insurance companies, health insurance companies dropping PPO plans and leaving their patients out in the street, basically. And so if you want to hear what we talked about, go to KCAAradio.com and listen to the podcast. Basically, it just confirmed what I've been warning about for the last 2 years, is that Obamacare was going to threaten folks' actual retirement nest eggs. And the reason is because a lot of these folks that wanted to continue using the same doctors and hospitals were going to have to pay out of pocket. So that was just one of the things that we talked about last week about what's threatening your retirement savings. But I want to talk about another thing this week that is a huge factor, something that threatens folks' retirement savings or their business. And that is just bad advice. I don't mean typically from advisors. Most advisors are licensed. In fact, all of them have to be. They're trained. They have continuing education. They have years of experience most of the time. And they, for the most part, 9 out of 10 advisors are doing what they think is right and doing what they were trained to do. However, the bad advice that most folks are getting today that is threatening their money and their business is from financial pundits or writers that just say stupid, ridiculous things. Bad advice, either on the TV, on the radio, in print media, bad financial advice is running rampant. It's just running rampant because everybody's got an opinion about something. And seniors especially believe a lot of the stuff that they hear and see or read. And that's dangerous because a lot of the people that are writing this stuff, they have no clue what they're talking about. And I'm gonna use the most recent egregious example of this. And this is in the latest Time magazine. It's the one with Angela Merkel on the front. She was just chosen as Person of the Year. And the title of the article is Why Washington is Fighting Over Your Financial Planner. And it's written by Maya Roden. Now, who's Maya Roden? She's an author. She is a journalist. She has no idea what she's talking about when it comes to finances. She goes and interviews stockbrokers and certified financial planners and gets their opinion. And then she writes articles on it. And this article that she wrote, it's about something that's going to probably be happening next year, which is really irrelevant to what we're going to talk about tonight. But the headline in this is the Department of Labor found that insufficient or non-existent investment advice led owners of retirement accounts to lose out on $114 billion in 2010. Insufficient or non-existent investment advice led owners of retirement accounts to lose out on $114 billion. Is she saying that investors lost out on gain that they could have realized, or is she saying that they lost money? Well, if you go read the article, she's pretty slanted here because she does talk about an interview that she did somewhere called the Garrett Planning Network, a national financial planning firm. Advisors often share stories from clients who found themselves on the receiving end of bad retirement advice. Now, I'm reading directly from the article, and this is what this knucklehead says. During an exchange last spring, one advisor recalled encountering a woman who was about to retire and had asked a non-fiduciary advisor, I don't know what that is, I don't know what a non-fiduciary advisor is. I guess she means non-securities license, which is what it's going to mean next year if they pass this law. But all of us are required to basically function as a fiduciary, which means we are supposed to function and act in the client's best interest. Okay, that's what a fiduciary means. But here I'm back to the article, and asked a non-fiduciary advisor, whatever that is, for advice about her $1 million 401k rollover. She was advised to invest in an annuity and a trust, a move that earned her advisor a tidy 7% sales commission. Cheryl Garrett, founder of the Garrett Planning Network, claims her advisors see that kind of behavior all of the time. That is what I'm talking about. This Maya Reardon has no clue at all what the circumstances were. First of all, let me clear something up. If the advisor advised this lady to put all of her $1 million into an annuity, first of all, he did the wrong thing. But secondly, I want to talk about something. The insurance company that he advised her to put her money into would have never allowed that. There is a screening process whenever an advisor turns in an application for an annuity that it's called suitability. The insurance company insists only a certain portion of somebody's net worth can go into an annuity if you're over 65. So if this lady only had $1 million, there's no possible way that that insurance company would have allowed her to put all of it into an annuity. Secondly, Maya doesn't do her homework and find out how much of the net worth this lady was addressing with this $1 million 401k rollover. This woman might have been worth $20 million. She just wanted to know what to do with $1 million of her 401k. So the way the article is written, it's as if annuities are bad things. And that's what happens with bad advice from ignorant journalists that don't know what in the heck they're talking about. Now, I'm not saying that annuity would have been the perfect thing to put this woman into, because I don't know the entire story, nor does the reader. But my point that I'm trying to make is, if you're a layman, if you're a senior, and you're trying to decide where you're going to put your money to keep it safe, and you read this knucklehead's article, you're going to interpret from her article that putting money into an annuity is a bad thing because a certified financial planner said so. Well, in the article, this Maya lady does not address the fact that had a certified financial planner talk to this woman about putting her entire $1 million into a mutual fund, the mutual fund would have never had any suitability questions to ask her. They would have taken her $1 million, gladly invested it into the stock market, and exposed it to market risk that this woman could have lost some or all of her money in a stock market if they were going to put it in a mutual fund. So let me ask you, if you read this article and all of a sudden it just says, wow, this advisor, a non-fiduciary advisor, recommended she put the $1 million into an annuity, as if it was a bad thing. What would the certified financial planner rather have her put it into? Real estate? Gold? A mutual fund? Individual stocks and bonds? How old is this woman? When does she need this money? Is she going to live on this money? There are so many questions that need to be asked. And yet, financial pundits all over the internet and in respected magazines like Time Magazine are making these claims and these idiotic presumptions and idiotic statements that confuse people and give them the wrong impression about financial products. And I think it's as big a problem in the United States as a stock market crash or a real estate market crash or anything. This bad advice, this prejudicing of seniors and investors and business owners on one product being worse than another without clarifying anything is dangerous. It's dangerous to investors because let me kind of go over briefly. Let's just say that this certified financial planner tells this lady, oh, I want to put it in a blend of some individual stocks and this mutual fund and some individual bonds and maybe some government securities, which is a nice little portfolio diversification there, okay? Every single one of those that I talked about has some market risk, interest rate risk, has risk incurred into it. Now, let's just say that some of that money this woman might have put into this annuity that this so-called non-fiduciary advisor recommended. Let's see what might be wrong with that. Number one, her principal would be absolutely guaranteed. So let's just say she didn't put $1 million in. Let's say she put $500,000. That $500,000 would never be exposed to any market risk at all. Zero. If the market crashed, if the real estate market crashed, she wouldn't lose a dime. If the stock market crashed, she wouldn't lose a dime. If gold crashed, she wouldn't lose a dime. If the global financial markets crashed, her $500,000 would remain $500,000. It wouldn't drop a bit. Now, would she get a competitive interest rate? Absolutely. The interest rates, the guaranteed interest rates on fixed annuities, not variable annuities, are sometimes 2 times what you could get on a traditional savings account. Much better than CDs. Now, would she have a guaranteed interest rate if she had put that $500,000 into the stock market? Absolutely not. Absolutely not. Would she have tax-deferred growth? If it was in an IRA or 401k rollover, she absolutely would. Okay, so she would have tax-deferred growth in both. But the key is, if she was retired and she wanted to do a 401k rollover, where would you put it where she wouldn't have any risk to her principal at all? Now, granted, she would have to have some growth. So I'm not advocating she put it all in anything. Nobody's that crazy for her to put her entire nest egg into one single thing. But what I am advocating is this. Get the whole story. Get the entire story. Most advisors ask their clients dozens of questions before they ever recommend a product. The first and foremost is, what are your goals? What are your needs? What do you want to do with this money? What's this money supposed to do for you? How long does it have to last? When do you want to access it? Do you ever need to access it? Where are your other assets? There are so many questions and so many answers that determine what somebody uses for their financial portfolio. But for an author or a journalist just to come out of the blue and make it sound like an advisor recommending an annuity to somebody requesting some information and advice on a 401k rollover is just, it's irresponsible, and it just goes to show how ignorant some of these people who write about finances really can be. And it's all over. It's not just this Maya lady. It's not just her. She's not the only one guilty of it. I hear respected pundits like Suze-Orman make stupid comments all the time. I hear Dave Ramsey make stupid comments all the time about life insurance. You know, some of the wealthiest people I know are some of the biggest advocates for life insurance because it is a way to transfer an estate tax-free to their heirs. There's so many reasons why you would use certain financial products. Nothing is a panacea. But for somebody just to arbitrarily come out and say something is terribly wrong for them without making caveats or exceptions or getting the whole story, to me, is just absolutely irresponsible. We're going to take a quick break because when we come back from the break, I want to address this a little bit more. And I want to kind of defend these products that get picked on so much. This is Rick Liuag, Safe Money Talk, KCAA, 1050 AM. We'll be right back. Welcome back to Safe Money Talk. This is Rick Liuag, your host. And before the break, we were talking about one of the greatest threats to retirees' retirement savings is getting bad advice. And I don't mean bad advice from advisors. That's bad enough. I'm talking about getting bad advice from folks that aren't even advisors. Knuckleheads that write in magazines, on blogs, go on radio shows, go on talk shows, go on TV that aren't licensed. They've never, ever advised clients financially. They've never taken a test. They don't have continuing education. They've not been vetted out. They just write. They just write and make stuff up and then give opinions. And that's dangerous because there's an awful lot of people out there that are listening to these folks. And this Maya Roden just wrote this article in Time Magazine. There's all kinds of egregious stuff in there. But what I want to give you an example of right now is let's take that client that was spoken about in the Time Magazine article. Let's just say I'm going to take this chart that I've got in front of me, because I did pull this out when I got the article, and I'm looking at this, and it's an actual performance from 1998 to 2013, okay, because that was the latest that this company put this together. And it's one of the most well-known fixed indexed annuities. And I'm not going to go into what fixed index annuities are on the show. I talk about them all the time, but I want to talk about now how they function compared to, say, a mutual fund. What I've got is a chart, and if you want this chart, I'll mail it to you or I'll email it to you. Just contact me at rick@rickliuag.com. That's rick@rickliuag.com, and I'll email it over to you. Just let me know that you heard about this chart on the radio show. But it's taking $100,000 in September of 1998 and putting it into a fixed indexed annuity. That means an annuity that if the stock market rises, the client gets interest, a percentage of the stock market growth. It's not invested in the stock market. It's interested credited to the account. If the stock market goes down, the client doesn't lose a dime. And it compares this fixed indexed annuity over 15 years, from 1998 to 2013. And it compares it to the performance of the Standard & Poor's 500 index. And there are mutual funds that you can purchase that piggyback right off the Standard & Poor's. So we took $100,000 and deposited it into an annuity, fixed indexed annuity, in September of 1998, and the same $100,000 put into a mutual fund, let's say, that's linked directly to the Standard & Poor's. So it doesn't even have to be a mutual fund. Let's just see how the Standard & Poor's performed to this. Well, through this 14 or 15 years, from 1998 to 2013, there was two huge crashes. The crash in 2001, 2002, and of course the crash in 2008 and 2009. So through those years, there were two huge stock market crashes, but there was also two big bull markets too. Okay. Now, if you would have taken the $100,000, one of these accounts at the end of that time, from September 1998 to September 2013, the balance in one account would have been $198,725. The balance in the other account would have been $38,000 less, $160,300. The account with $198,000 in it was the fixed indexed annuity. That fixed indexed annuity never grew over 6% in that 15-year period. Yet it still outperformed the Standard & Poor's index by $38,000. And the reason is because in the two down years, the huge down years of 2001, 2002, and 2008, 2009, the Standard & Poor's lost almost 40% each time. So it had to recoup. It had to recoup those losses. In those two down years, that fixed indexed annuity didn't lose one single dime. So I want you to think about something. What if one of these retirees needed to take their money to live on or pull it out for some medical emergency in those down years? They would have taken a beating. They would have taken a huge loss. So anybody that says the fixed indexed annuities are bad or dangerous just don't know what they're talking about. I'm not advocating that you use them for everything. I'm advocating that they're just like the three little pigs. You build your house on straw, sticks, or bricks. And everybody, no matter what age you are, should have a portion of your retirement savings in a fixed indexed annuity to protect from down years. There's so many more things to consider, but as a whole, across the board, they are safe and sound investment tools that you can use for your retirement savings. Now, have you ever wondered why so many retirees are putting their money in the stock market? I do all the time. I wonder that all the time. Now, I know there's good reason, okay, because granted, the market has performed stellar the past several years, so there's a lot of gains in there. But if you think that's going to continue, you're sadly mistaken. What goes up must come down, and 2008 should have proven it to you. And if not, there's been several examples of that, especially over the last 50 years. But the reason why I'm asking this is because obviously these people, they weren't born with this idea to have their money exposed to this much risk. And I think there's a lot of reasons why there's a lot of investment in the stock market, even today, from seniors that aren't working anymore and that need this money to live on. They still have it exposed to risk of loss. And the reason why I'm asking is because I wonder the same thing all the time. And you see, I specialize in working with people's safe money. So I get a little confused when people start talking about how risky they're all the things that they're doing that's risky. But your safe money is usually what I would call the retirement money that you can't afford to lose. That's sacrosanct money. Safe money retirement strategies might be a concept that you've never heard about. And I'll tell you why that is in just a moment. And it has to do with education and advisors educating people, and primarily how advisors are trained. That's one of the things that I want to talk about is how these advisors are typically trained and why so many people are exposed to risk. But let me ask you a quick question first, because I want to get back to this fixed index annuity thing. Is what if it were possible for you to take advantage of stock market gains but never participate in stock market losses? Now, think about that. Think about what I just said. What if you could have your cake and eat it too? What if you could actually participate in stock market gains but never participate in stock market losses? That's right. You win but never lose. Have your cake and eat it too. What if you could be guaranteed a first-year return of, say, up to 7%, then lock in whatever gains you ever get from market upswings? So think about this. You get 7% one year, maybe 6%, and like a ratchet wrench. For those of you mechanics out there, a ratchet wrench, you turn it and it can never go backwards. Walking up a stair step, once you take that next step, you can't go backwards. So you lock in your gains. If the market goes down, it doesn't matter. You've locked in that gain. Whichever gains you get. Okay, so you never ever have your account drop in value unless you take money out. That's the only time you would see your account drop in value. So it sounds too good to be true, right? Well, that's exactly what millions of in-the-know retirees have been doing for decades now to protect their precious, cannot-afford-to-lose retirement nest eggs. Regardless what the world economy does, they know that this money, that money that's over there in that annuity, is protected. It's there, it's good. Some opponents would argue, well, listen, that annuity is only as strong as the insurance company, which is very, very true. But I want to tell you listeners, whether it's live or it's on the podcast, I want to remind you that in 2008 and 2009, over 200 banks folded and tens of thousands of depositors lost millions and millions of dollars. Over 200 banks failed and closed their doors. In the same time period, 0 life insurance companies failed and closed their doors. Life insurance companies, you can drive into any big city in the United States and see that typically, it's been an old joke, the biggest buildings in town are owned by the life insurance companies. And one of the reasons is because life insurance companies in every state are restricted from taking some of their money and investing it in risky investments. Because of the insurance laws in each and every state, these insurance companies have to be very, very, very conservative with where they invest, unlike banks. However, there's still people that say, well, I would rather it be in an FDIC-insured bank account. Well, I'm going to talk about FDIC in just a second. But over the last couple years, and I do know what I'm talking about, because in 2008, not one single client of mine lost a dime that were in these products. Not one. I still have people calling me today saying, man, Rick, I'm so glad that I was in this. Man, when that thing crashed. Now, granted, I didn't make the big gains in the bull market, but I didn't have a lot to make up because I didn't lose any money in those down years, so thank you. Over the last couple of years, I've helped clients move literally millions of dollars into these types of safe money accounts. And I specialize in working with individuals who are approaching or or in retirement, specifically working with their 401k rollovers, IRAs, and their other accounts that need to be protected from risk of market meltdowns or taxation. So I know what I'm talking about here because I've seen it. I've been on both sides. I've been a stockbroker, and I've seen what happens when people lose their money, and I've been a safe money advisor like I am now for several years, and I see what it's like when folks don't lose money and everybody is losing money. You may be wondering, how can they be guaranteed? And again, I'm going to go back to that. It's based on the assets of the insurance company and their ability to pay. Let's get back to the question of why somebody would have their money in the market. First of all, let me ask you, if you do have money in the market, was it your idea? The chances are that sometime in your high school or college years, some teacher or professor introduced you to the idea of investing. After school, after college, you probably got a job, and then during your first day at work, the human resource staff introduced you to the concept of the 401k. We have a 401k here, and we have matching employer contributions up to X. And the advantages of using pre-tax money from your paycheck to fund your retirement. All good, all great. After investing in the stock market, you now had a reason to start paying attention to what was going on in the financial world. So when you got, I remember when I got to this point in my life, I remember watching the nightly business report on PBS religiously. Today, most people watch CNBC, Bloomberg, or Fox Business News to get their financial news, okay? Basically, what I'm trying to say is that everything from your professor, everything and everybody, from your professor to your job to the news and financial shows on TV, has always told you to work hard, invest your money in the market, and your retirement will be secure. Now, here's a tough question. How is the retirement going for all those people that told you to put your money in the market and leave it there? In other words, what about a lot of those folks that retired right around 2008 and 2009, started living off that money, taking the required minimum distributions at that level maybe, and have they got that money back? I doubt it. Here's probably what most of those people won't tell you. They won't say, my retirement money's doing just fine. I've been participating in the market for the last 20 years, and I've locked in all my gains and have never participated in any market losses. They can't tell you that. They cannot tell you that, and they won't tell you that. There's a reason why almost every person you talk to today about money looks like a deer in the headlights. There's so many different opinions out there, and seniors, for the most part, they're the ones that are getting the most confusing advice. And I see it all the time. I see some people that I respect saying, load up on dollars. And then other people that I respect saying, no, the dollar's going to crash. Get rid of all your dollars. So if these are respected people saying contrary things, how is the layman who doesn't understand finances going to, what are they going to think? So you know what most seniors do? Nothing. They just sit there and do nothing because they're confused. I want to tell you folks something. In 2008, right before the crash, weeks before the crash, the big crash, the one we all read about and we remember, Hank Paulson and Bernanke, the Treasury Secretary, who at one time was the chairman of Goldman Sachs, one of the most respected investment banks on Wall Street in the world, and Ben Bernanke, the chairman of the Federal Reserve, both publicly stated that everything in the economy was just fine, was absolutely just fine. Either they were lying or they didn't know. These are two of the most well-respected and supposedly experts in finance, and they didn't predict what was about to happen. So how could the knuckleheads on TV or writing articles in Time magazine, how can they predict? They can't. So what we're advocating is, if nobody can predict one way or the other, why not be safe? Why not be safe? You still have to have growth. You still have to have liquidity. And why not be safe? Now, don't get me wrong. I'm not saying that brokers are bad people. I used to be one. I know how they think. I know what they're trained to do. They usually mean well. Brokers are not trained to focus on preserving and protecting your money. When I discuss financial advisors with other financial advisors, we all agree that brokers and financial planners, they're not bad. They're just different than what we do. And I sympathize with them because when I was a stockbroker, here's what we were trained to say, to think, and to do. Your financial advisor typically, if they are securities licensed, they are typically trained to think in terms of growth. They are trained, it's in their DNA to think and look at everything in how to grow your money. And that's great when you are in the accumulation stage of your life. When you're in the accumulation stage of your life, you're working, you're earning money, you're putting it away in your 401k, you're not taking anything out of it, and you've got time working on your side, and you can weather any storms, and you can probably recoup your losses over time in a tax-deferred 401k if you continue to make contributions. Stockbrokers and financial planners are usually, and money managers are usually fixated and focused on taking that money and making it grow into a bigger number. In the meantime, risk is just part of the equation. Risk is just part of the equation. We'll try to mitigate as much of that risk. I can hear it now. This is what we were trained to say. We'll try to mitigate that risk. But when you're over 65 and you're not working and you're not contributing to your 401k anymore, risk is a 4-letter word. Risk is not good at all. Losses are a very bad thing when you're over 65. I'm going to delve into this a little bit deeper, and I'm going to talk about how Obamacare threatens your retirement savings after this break. Carlos, we're going to take a quick break. This is Rick Liuag at Safe Money Talk, KCAA 1050 AM. We'll be right back. Welcome back to Safe Money Talk. I am Rick Liuag. I'm your host. And before the break, we were talking about the danger of uninformed journalists and financial pundits giving financial advice. And I want to give a perfect example of this. This is about one of the best examples I can give about somebody that doesn't have a clue what they're talking about, that millions of people listen to and take their advice and are going to end up in a car crash of financial ruin because they listen to this person. On this particular subject, on just this particular subject. I don't want to pick on him about everything, but I do want to say on this particular subject, he's a knucklehead. Let me describe something, okay? Let's just say that you had an account. You had an account that had two sub-accounts in it, that you would put money into it each and every month. And in one account, it would build up like a savings account. And at any time, you could take money out of that savings account for any reason that you wanted to. Whether you wanted to put an addition on your house, whether you wanted to buy a new car, whether you wanted to gift your grandchildren $10,000, you could take money out of that account tax-free. You wouldn't have to pay tax on it at all. So it would have grown at a admirable rate of return, savings account rates, maybe a little bit more. And you could take the money out at any time, tax-free, not pay any tax on the gain. And what about this? The second sub-account started out with maybe $300,000. Started out with $300,000. On day one, when you made your first deposit into this account, the institution automatically had $300,000 in your second sub-account. Now, here was the caveat. That $300,000, you could not access it and use it unless you died. Now, that is traditional life insurance, okay? But let me take it one step further and change this account now. That $300,000, let's just say that you got Alzheimer's and you are going to be confined into a nursing facility, nursing home. You could take that $300,000 out, and it's a heck of a lot more than you had ever put in. Let's just say you had been making $200 or $300 a month deposits into this account for 10 or 20 years. There's $300,000 in there, and you get sick. You have a heart attack, you have a stroke, and the doctor or the hospital that you want to go to doesn't accept your Medicare Advantage plan, or they don't accept Medicare anymore because the Medicare reimbursements have dropped so low because of Obamacare, they can't afford to accept Medicare anymore. Now, if you think I'm crazy and you think that I'm crying wolf, it's already happening. It's already happening with the standard Obamacare plans. I told you about that last week. I'll talk about it a little bit more in just a minute. It's a for sure danger. The point I'm trying to make is if you get Alzheimer's, There's nothing that any insurance agent in the United States can provide you that would give you cash. Other than this one policy, there's no such thing as Alzheimer's coverage, that if you get Alzheimer's, you get a lump sum of cash. There's just no policy like that. So you could make monthly premium deposits into this type of life insurance policy, have the traditional savings account provision that you could take money out tax-free at any time you want to, or you could accelerate the death benefit, and you could take out the death benefit if you have a heart attack, a stroke, kidney failure, any other critical or chronic illness like Alzheimer's or dementia, or if you're diagnosed with a terminal illness and you want to seek medical treatment somewhere out of the country. Your Medicare is never going to pay for that. What does Dave Ramsey recommend you do? Well, I would like to know what Dave Ramsey recommends. If you're getting cancer treatment right now and your PPO by Blue Cross Blue Shield decides Blue Cross Blue Shield is the provider of your PPO plan and decides in 2016 that plan's no longer going to be offered, that you now can't even get a PPO plan, you can only get an HMO plan, and the doctor and hospital that you want to use or the facility where you're getting your chemotherapy or the chemotherapy drug you're using will no longer be covered by your health insurance plan. What does Dave Ramsey recommend you do then? The only thing that you can do in that scenario to protect yourself, no health insurance policy in the world is going to protect you from that. You already were spending thousands of dollars on health insurance. The only thing that you could do in that particular instance, if you wanted to continue to go to that doctor and hospital and pay out of pocket or go somewhere else out of the country, is use your own money. You'd have to dip into your retirement savings or, God forbid, use a credit card. Nope, Dave doesn't want you to have any credit cards. So for him to say that life insurance is stupid and that people shouldn't have it, permanent life insurance, he's just dead wrong, especially as a result of Obamacare. And if you don't believe me, go to last week's podcast because I gave you several examples of people in Houston, Texas, who were notified this year that their PPO plan is discontinued for 2016 and they no longer can go see their oncologist. And they can no longer use MD Anderson, which is the premier cancer facility in the United States, according to U.S. News and World Report. They're kicked off. They can't use it anymore. So if those people want to go back to MD Anderson and they want to continue to see their oncologist, they've got to either burn through their retirement savings or they have to take a reverse mortgage on their house, borrow the money, do something else, but it's going to come out of their pocket. There was another example I used last week. This another gentleman in Houston, Texas, that was on a special chemotherapy drip from a specific clinic. He was notified that his PPO was no longer going to be continued in Houston, Texas. His HMO would now be his only choice, and that particular chemotherapy drug would no longer be available to him. If he wanted to continue, it was going to cost him $70,000 a year. What does Dave recommend he does? My point is this. There are so many people out there giving advice on subjects that they don't really know what they're talking about. Dave Ramsey knows a lot about credit cards and credit card debt and how to get out of credit card debt. But for him to say something as ridiculously stupid as permanent life insurance is a waste of money, I will give him several examples of people that had these policies that when they were diagnosed with a critical illness, they could accelerate their death benefit and they didn't have to burn through their retirement savings or their retirement nest egg and die bankrupt or be bankrupt after they survived whatever critical illness they had. So my point being through all of this is make sure that you're not taking financial advice from people that don't have licenses, that haven't been trained, that have never had the first client tell them their entire financial situation, and they've never, ever, ever broken down these particular products and seen exactly how they work and when they work. They're smart people. Dave Ramsey's a smart guy about what he knows. Suze-Orman is smart about what she knows, but there's a lot that they don't know. There's an awful lot that they don't know. And for them just to make arbitrary comments like life insurance, permanent life insurance is ridiculous and it's a waste of money, I completely disagree with that. for the very reasons that I told you. There is no other financial tool that I could tell clients about today that they are guaranteed to get back more money than they ever put into it, guaranteed to get back more money than they ever put into it with zero financial risk. There's no other product, whether it's them, their estate, or their heirs. Permanent life insurance is the only one of the only financial products in the world I can tell a client, you are guaranteed to get back more money than you ever put into it, just as long as you don't let the policy lapse. And it's either going to come to you or it's going to come to your heirs or your beneficiaries. Now I can tell them this. Now you can use premium dollars, immediately get a stepped-up basis. Stepped-up basis, for those of you out there that don't know financial jargon, okay? A stepped-up basis means that if you put in $1 and it now is $10, that's a stepped-up basis, okay? So you can use a stepped-up basis concept for life insurance. With life insurance, I can make one premium payment, and immediately have a bucket of money that could be several hundreds of thousands of dollars that I could have access to if I'm ever confined to a nursing home, if I'm ever diagnosed with cancer, if I'm ever diagnosed with a heart disease, life-threatening heart disease, if I have a stroke. I now have a pool of money that's way more than I ever put into it, a big, gigantic pool of money that I can use in case of a medical emergency. Now, granted, Dave, I can't pull that money out and invest it, but I don't want to. That money is for a specific purpose. That product serves a specific purpose. That product, Dave, is augmenting the crappy Obamacare plans that are out there. That pool of money out there, Dave, is augmenting and protecting somebody from Blue Cross Blue Shield canceling their PPO plan right in the middle of their cancer treatment, Dave. That's what that life insurance policy does. And there's no other policy that I can sell them or recommend to them. That life insurance, that pool of money, Dave, is there. And let me give you an example. If $300,000, if they get Alzheimer's and have to be put in a nursing home, they can take out up to, say, 85% of that $300,000, they can use that money for nursing home care or home health care. And guess what, Dave and Susie? Unlike long-term care insurance, whatever they didn't use of the benefit stays in their estate. You can't say that about long-term care, Susie. You can only say it about this death benefit that they can accelerate. Long-term care, you may never spend what you put in. You may never, ever use it. You may never get back as much as you put in, let alone more. Now, you might. With this policy, you're guaranteed to get back more than you ever put in, and you can use it for either a death benefit, long-term care, critical illness coverage. You can use it if you're diagnosed with cancer. You can take that money and pay off all your bills so you're not leaving your spouse in debt. You can do whatever you want to with it. And for somebody to arbitrarily say that life insurance is a waste of money, they don't know what they're talking about. That's what I wanted to talk about tonight. I got all worked up last week about these PPOs being closed. And guess what? Four more major Arizona insurance carriers are dropping PPO plans in favor of HMO plans. What that means, for those of you that have PPO plans, you know what it means. PPO plans mean choice. PPO plans give you choice of doctors and hospitals. HMOs don't. PPO plans have larger networks, more choice. If this is happening in Houston, Texas, folks, if doctors and hospitals are becoming unavailable to Obamacare-insured members in Houston, Texas, what do you think is going to happen in California? It already is happening here. What do you think is going to happen in Omaha, Nebraska? What do you think is going to happen in Raleigh, North Carolina? It's already happening. And let me tell you what's next, and this is what should worry all of us. The next shoe to fall on all of this, is Medicare networks are going to be shrinking. Medicare Advantage networks are already shrinking, but here's what I'm predicting, and I hate to predict this. Over the period of the next 5 to 10 years, I'm predicting that having Medicare will be no different than having Medicaid, or in California, Medi-Cal. I'm also predicting, as a result of Obamacare, that there are going to be many, many Americans, seniors, dying because they could not get the medical care that they were promised or that they had before or that they especially that they needed. And I'm also predicting, as a result of Obamacare, that there are going to be millions of American seniors that may not die, but they'll be bankrupted by a catastrophic medical expense. That never would have happened prior to 2014, prior to Obamacare taking full effect. But I can tell you, most of the folks like me that have read the bill and understand it and see all of the moving parts of it and see how it's evolving, it's inevitable. It's inevitable that the same thing are going to happen to seniors that have been happening to folks that aren't over 65 the past decades or so. And every one of you have heard stories of women that get breast cancer. They have a job. They have to leave their job in the middle of treatment because they want to recover and they don't want to be burdened down with a job. And their spouse says, honey, come home from work. They go on COBRA. They can't afford the COBRA anymore. They lose their health insurance because they can't afford it. They can't go see their doctors. They can't get the same medical care that they were getting before, and they pass away. And I predict that that's going to happen to seniors as a result of Obamacare. And if it doesn't scare you, it should. I've got a lot more information on that. You can contact me at 800-568-3817. Request my new book titled, You're Going to Need a Bigger Boat, How Obamacare Threatens Your Retirement Savings. If you want to get with me, you can visit my website at www.rickliuagagency.com or our special blog on Obamacare, which is www.obamacare-uncovered.com. There's a wealth of information on there for seniors and business owners. Until next week, God bless you. Tell all your friends, relatives, and even your employer to listen in to Safe Money Talk with Rick Liuag every Tuesday, 6 to 7 on KCAA 1050 AM. Take care. Have a great week.